Good morning, students. How are you all doing? Yes. Welcome back, everyone. Welcome to our morning classes. I believe this is the best time to crack your brains with technical topics because this is the time when our brain is the most uncluttered. Once the day starts and you get up into multiple things, so many things adds up to your mind, and then putting something which is technical, which is slightly uh, dramatic, becomes a challenge. So it's good that we meet in the morning. I'm also happy that for me, when I conduct a class in the morning, my entire day goes very fresh, very energetic, because when I connect to students who are eager to study, who keep on putting in their queries, doubts, and who are very receptive, that gives me a different type of energy throughout the day. So with this energetic start, it makes the whole day more productive for me. So students, yes, very good morning. Santosh, Anchal, Dhanalakshmi, Sridhar, Aditya, Vijwal, Vishakha, Mehak, Isha, Akash, Sushmita, Kambhira. Everybody, a very, very, very good morning to you all. So, as discussed in the previous class, this topic, which we call as PGBP, is a very, very important topic in the entire subject of income tax. Important point about PGBP is that this subject, or rather this topic, is the base of your income tax practice. So when you are into practice after your completion of qualification, you will find that day in, day out, one, for income tax return filing, you do computation of PGBP, and later on in future, whenever people get notices from the income tax department, majority of the notices are related to PGBP. Now you'll say, sir, what is so important about PGBP, or what is so technical about PGBP? That you'll understand today. But before that, we will try to revise, we'll try to regroup whatever we did in the previous class so that we are on a page to go to the technical part of the PGBP subject. Along with this, I'm sure by now, since you all have read something from the module as I had given you a target, so you also will be having some queries, some doubts. So now that will add up more to a better understanding of the topic. So as we were discussing in my previous and the first lecture, that basically the question that you get on this topic could be of two types. One is the comprehensive sum, the compulsory question, where you are required to compute total income and at times even the tax liability. And in this computation, you have to compute, if required, the income from salary also, house property also, PGBP also, other sources also, maybe deductions, and finally the tax liability. Now, in this case, your main answer format would be something like this. The first starting part or the first page of your answer will be showing the total computation up to the tax liability. And then for each of these parts, you'll prepare a working note, like income from salary, you go to the salary format. Income from house property, you go to the house property format, and so on. Now, this is the first type of question. Second type of question is where you will have a question specifically on only PGBP, like how you solve sums on salary, how you solve sums on house property. There could be a sum exclusively on PGBP. Now, interestingly, whether it is comprehensive or whether it is exclusive on PGP, the sum remains same. The sum will be what? Again, in sums, there could be two type of sums. One would be like how we solved one in the previous class. You would be given a trading P&L account with all the details which you have seen in your 11th standard trading P&L, and maybe till today if you are doing some trading P&L sums. And along with the details, you have some additional information. This is where it will become related to more income tax adjustments. So one type of question is this. Second type of question that you are going to see as we proceed for computing PGBP income would be, they will not give you entire P&L. They will only give you the net profit. The sum will say that Messrs. PQR Limited is a manufacturing concern engaged in this type of business, provides you its details for the financial year 25-26. Point number one, the profit and loss as per the trading P&L account is 50 crores. And then after that, in the further points, they will mention one by one that this amount is debited to P&L, this amount is credited to P&L, this amount was missed to be debited or credited from P&L. So they will give you entire details in the form of information. So whether the sum is like how it is on your screen, a trading P&L given with some additional information given, or directly information given about the trading P&L along with net profit, your PGBP computation format remains the same. What is the PGBP computation format? There are two formats. You can prepare a complete P&L again, but only considering PGBP, or you can follow the reconciliation format. Now, when you get the first type of question, what is the first type of question? P&L given, entire P&L given with additional information, then you can follow both formats, the first format of making P&L again, or the second format of reconciliation. But this is possible only if you get the first type of question. But many times in the exams, you will find that you get the second type of question. What is the second type of question? Entire trading P&L is not given. They are giving you net profit and they are giving you some information about what is debit or credit in P&L. Now, students will understand this, that if they have not given you entire trading P&L information, you cannot redraft the trading P&L again. So in such type of questions, which you will find more, especially when you come to finals level, the second type of questions are more. In that case, there is only one option available with you to solve the question, that is the reconciliation format. And that is why we also regularly follow reconciliation format only, so that the format is such that irrespective of the type of sum, irrespective of the type of information given, you should be able to solve it. In fact, even in our module, if you remember, I had asked you to read the module starting from the first part, which is the format. They have also only given you the reconciliation format. Why? For the same reason that this format can be applied to all type of questions. Now, important point again is that this is in this head is not only for computing the PGBP income or total income. This head is also important where you will get the questions where case study is given and you are required to solve some MCQ questions. Again, that question is a comprehensive question because a case study given. The case study has lot many details, and out of the 10 MCQ questions given, definitely 2 or 3 would be relating to independent PGBP adjustments. So this is the relevance of this chapter. Firstly, since it is very important in your professional life, hence it has been made an important topic even for exams, both at inter level and again at final level, where you are going to compute income of different entities like trust, like companies, like AOP, BOI. So when you will be computing income of different entities, again, majority of these entities would be doing what business. So the main computation would cover PGBP only, right? Now, having said this, how to solve PGBP? So when you are given a trading P&L, or even if trading P&L not given, you are given, as I said, the second type of question, the details about P&L in the form of sentences. In both cases, the first step For solving this head sum is, I call it as segregation. Now, what is segregation? So segregation step is you have to identify from the question as to what are the incomes or expenses given which are not related to business head. So if you remember in the previous class when we solved the question, before that I had given you this example. So in this example, you have to mark or you have to identify which of these items are business related and which are not. So like this. As you can see, interest on debentures, dividend on shares, profit on sale of shares, rent received, all these are items belonging to some other heads. So you need to identify that, okay, these items do not belong to PGBP. Why? Because we need to adjust this particular items in the reconciliation statement. Either the adjustment could be add or it could be less. Whatever it is, you have to add or less these items in the P&L. Now, why do you add or less? Because of the simple mathematical reason that our starting point in the question is this net profit. Now, you have to always keep at the back of the mind how this net profit was derived by adding all these incomes and subtracting all these expenses. Now, if I identify that out of all the incomes, these 4 or 5 items are not part of business head, then in order to find out only business profit, I will have to adjust them. What adjustment I will do of these? I will subtract them. So the adjustment that I have to do of these items is what I will subtract them. Now here, I'll just discuss this format as a formula also. So as a formula, the format is like this. You start with your net profit as per accounts, and then whatever items are already credited to P&L, as I was showing you, but they are not taxable under the head PGBP. Now what it means, either it is taxable under some other head like other sources HP, or it is not taxable at all. Whatever is the reason, it is not covered under PGBP. So what you have to do is you have to subtract it. Right? Is this clear? Now I'm again explaining you the reconciliation format or formula. Similarly, the second possibility could be that there are multiple items on the expense side. Now, there are 2 possibilities when we talk about the expense side. Again, either the item is not at all related to business head like this. What is this? Loss on sale of machinery, it is a capital head item. Municipal tax on property, which is let out, it is a HP head item. So first possibility on the debit side is this entire amount which is debited. In other words, which is subtracted while deriving the net profit, is not covered in the business head at all. So there could be reasons like items which are debited in P&L, but they are not to be subtracted. Now, when we say in simple language, not to be subtracted, in technical language or in the PGP language, they say it is not allowed as deduction, or they say it is disallowed. Means PGP head does not allow those expenses to be considered. Now, please understand this. Mathematically, what has happened? While deriving this net profit figure, you had subtracted these items. Now, I want to remove the effect of this. So what I'm doing, I am adding these items. So see, simply by giving the opposite effect, you are able to remove the impact of that particular item. Now, for the debit side, one possibility is that these items completely are not part of PGBP, so I have added. Now, second possibility, which you will find in the debit side regularly, is that there is an item like depreciation, which is considered or which is allowed in PGBP. So it is a part of PGBP also. PGBP allows this expense. But what is the difference? Difference is in the amount. So as per accounts, you have debited 2 lakhs. As per PGBP or income tax provision, it should be 250. So you'll find this type of adjustment also, where not the entire amount, some part of the amount has to be adjusted. Why? Because accounts and PGBP both have different provisions, different calculations, because of which some part of the amount is having a difference which requires reconciliation. Now, for such type of items, which is covered in both income tax also and accounts also, and there is a difference in the amount, what you have to do is two possibilities. Like for depreciation, the common format which is followed is we add the entire amount of depreciation which is already debited in P&L, and we subtract the entire amount which is as per income tax. So first way of handling this is you give effect to the entire amount. This generally is done for depreciation. So even in module format, you will find this, that whatever is the depreciation as per accounts, which is debited in P&L, you will add that amount completely. And whatever is the depreciation as per income tax provisions, which is given in the adjustment or you calculate in the working note, you subtract it completely. However, we will not do this for all adjustments. For all other adjustments, we have to give effect to the difference amounts. So if you remember my previous example, which we solved, there was some amount which had to be adjusted. So we only adjusted the difference amounts, like you'll find here. Now, this is where slightly students get confused. Why? Because whether this difference has to be added or this difference has to be subtracted. Many times this is the confusion. Now see, one is you understand this with logic, like as I was explaining till now, what is the effect on your net profit, whether it is subtracted, added. But if that logic is not working for you, today I'll give you one more interesting method of how to decide whether you should add or less. Correct? Now, this concept, which I'm going to tell you right now for reconciliation, is applicable in all subjects wherever you do reconciliation, starting from your accounts. So in accounts, you have done reconciliation like bank reconciliation. And now also in accounts in different chapters, you'll be doing reconciliation. You do reconciliation in GST. You do reconciliation in FM. You do reconciliation in costing. In whichever subject you are doing reconciliation, the format which I will show you or the idea which I'll give you right now will be very, very helpful. Right? So pay attention. What is this idea? So I raise my hands. I keep my hands like this. Now, what are these two hands representing? One hand is representing net profit of accounts. Another hand is representing net profit of PGBP. So accounting net profit, PGBP net profit, correct? So you have understood this firstly. So I keep my hands like this, accounting profit, PGBP profit. Now, what is the adjustment? I find that there is some amount which is debited in P&L. Now just understand one thing. What will happen if any amount is debited in P&L? This hand will come down. Why? Because the profit has to reduce. The profit is less because you have debited that amount in P&L. Now you have to check what is the impact of that amount on PGBP. Let us say first simple possibility, that amount entirely is not allowed in PGBP. PGBP does not allow you deduction of that expense. So what is the point? The amount is debited in P&L, so P&L hand is lowered because the profit of P&L is less by that amount. But PGBP does not allow deduction of that amount, so PGBP hand remains here. Now, what is the position? The position is accounting profit is less, PGBP profit is more. Now in reconciliation, in all the sums, you are going to start with your profit as per accounts and you have to reach to profit as per PGBP. Now, because of this one item, which is debited in P&L and hence P&L profit is less, this is the position of your profits. PGBP profit is higher, accounting profit is lower. So what you have to do, you have to climb upwards because your starting point in reconciliation is accounting profit. So you have to go upward. What you will do, you will do add. And this is what we exactly did for all those expenses which are debited to P&L, but which are not allowed as deduction. See, debited to P&L, but not allowed as deduction. Similarly, second simple case, there are many items of incomes which are credited in P&L. Now, if any item of income is credited in P&L, what is the impact? P&L profit is more. But those items are not taxable in PGBP. Why? Because they are relating to other heads or they are exempt. That is why they are not taxable here. Now, because of these items, what is the impact? Your accounting profit is more because these are items of income. They are credited to P&L, so accounting profit is higher. But they are not taxable under PGBP, so PGBP profit remains as it is, no effect. Now, in this case, your accounting profit is more. Our starting point is accounting profit. You have to climb downwards. So what you have to do? You have to subtract. So as you can see, the second reason is you have to subtract those items which are credited in P&L means shown as income, but they are not taxable under PGBP. Now you apply the same logic for those items which are there in both accounts and PGBP, but with different amounts, right? So like we solved in the previous class, the question said the P&L debit was administrative expenses 1.5 lakhs in P&L, that is accounts, but PGBP said no, out of this 25,000 is not allowed for some reason. So PGBP allows only 1,25,000, accounting had debited 1,50,000, so there is a difference of 25,000. Now same logic. Now what is the logic? My P&L is debited by 1,50,000. So this hand comes down. PGBP also allows it, but only up to 125. This also comes down, but not completely. So what is the situation? My accounting hand is lower. My PGBP hand is higher. And what is the difference between the two? The difference is 25,000. That is the gap. I repeat. So my accounts has debited 1,50,000. So 150 is here. My PGBP allows, but only 125. So 125, this hand is also lowered. Now there is a difference between these two hands of 25,000. Now in this case, what will happen? My accounting profit is lower as compared to PGBP. So I will climb upwards. I will add 25,000. So what is the point? Administrative expenses is covered both in accounts and PGBP, but the amounts are different. Second example. Let us say research and development expenses debited in accounts is 1 lakh. Correct? Research and development debited in accounts is 1 lakh. But business head says we allow it up to 1,80,000. Now in this case, my business, that is PGBP hand, is much lower than my accounting hand. Why? Because accounts allows only 1 lakh, whereas business head, that is PGBP, allows 180. Now in this case, what has happened? My PGBP hand is lower than accounting profit. So now I will climb downwards. I will subtract this. If you understand this logic, you need not learn or remember what is to be added, what is to be subtracted. You can always compare your hands and you can identify the answer, right? I'll take your queries, put in the chat box. So Mehak is saying, sir, under optional and default scheme, PGBP calculation, any difference? See, beta Mehak, in the previous class also I said, we will come to the difference later. Let me first explain you entire PGBP head, because fortunately in PGBP head, there are only 3 items which is different between the default regime, that is the new regime, and the old regime, that is the optional regime. So only for those 3 items, you have to do a different calculation. But still, what is important is the format which we are studying, add less, that is the reconciliation, remains same. Only for those 3 items, in optional regime, you will do something else. In old regime, you will do something else, correct? Anil is asking, so where there is no clash between accounts and income tax, so what will happen? See, there would be many items which are present in both accounts and income tax, and the amounts are also same. Now, simple, Anil. Let us say there is a debit expense, purchases of rupees 5 lakhs in accounts. So 5 lakhs, this hand is lowered. And even PGBP allows 5 lakhs. So PGBP is also lowered. Now, they are at the same level. So when they are at the same level, you have to do nothing. So what is the point? Where any item, debit side or credit side, is same. It is there in accounts also, and the same amount is there in PGBP. You don't have to do any adjustment because we do reconciliation only for difference amounts. So only reconciliation is required whenever there is a clash. Isha beta, even if there is a loss, I follow the same method. Then instead of this, calling it as profits, I'll call this as loss. And again, you see what will happen. If there is a loss and if there is any debit in P&L, what will happen now if there is a debit in P&L, it increase your loss. Correct? Omkar beta, don't worry. As we proceed, we will be repeating this again and again. See, I have given you two approaches. First approach I gave you in the previous class. What was that approach? That you have to only remember one thing, that the items which are debited in P&L has been subtracted from net profit. So now you have to give the opposite effect. Items which were credited in P&L were added. So now you have to give the opposite effect. This is one. And this approach is the second approach. So Omkar, it may take time for you to understand, but don't worry. You keep following what I'm doing. Try to apply this. You will also understand. But what do you mean by fixed and fluctuating, Anil? I did not get this. Sushmita, I'll come to your point. Just mention the page number. You said na something 0.9. Just mention the page number. Okay, Sushmita, I'll come to that page. Okay, students. So now when you have to solve PGBP sums, the first thing that you have to do is you have to do segregation. Segregation of what? Identify those items which are not part of PGBP at all. Why? Either because they are covered in some other head or they are not at all taxable under the income tax law. For those items, you require this add less first. Now, once you have identified the items which are different, that is not part of PGBP at all, and you have done their adjustments, now the second step comes for the remaining items in P&L, which are there in accounts also and which are in PGBP also. Now, the second step is you have to apply PGBP provisions. What do you mean by apply PGBP provisions? Now we have to study PGBP in detail as to what incomes are allowed in PGBP on the credit side, what expenses are allowed in PGBP on the debit side, and up to what amount. Once you identify the amounts also, now again you will compare these amounts. Okay, as per income tax, this amount is allowed. In account, this amount is debited. Is there a difference? If there is a difference, again we will do reconciliation. Now, for applying the provisions in the previous class, I started with this, that I have divided, for your simple understanding, the entire PGBP, which is one of the most vast heads, into two categories. First is those provisions which are dealing with credit side, that is the income side, and those provisions which are dealing with the debit side. On the credit side, there are only two sections, 28 and 41, which deals with what items would be covered on the credit side of PGBP. In short, only two sections gives you the list of incomes which will be covered in PGBP. Now, what these two sections cover? So section 28, which is your main section, or it is the main provision which tells you what comes under PGBP, has given you a list which we were studying in the previous class. That list is basically covering what? To put it very simply, it covers those receipts which you earn by doing business. So in simple words, whatever is the nature of your business, according to that, you will have some type of business receipts which may be called as sales, fees, freight, tuition fees, whatever. So depending upon your nature of business, there would be some receipts which are directly earned by running your business. So those are covered in 28. And then we saw in the list of section 28, there are some more items which indirectly arise from your business. So as we were dealing, we studied this section. See, this is the list. So first is the direct amount, which is arising from business, which they have covered here as first point. Then comes all the indirect amounts. So in indirect amount, you have compensation, then fees, which is charged by these trade or professional bodies, like our ICAI is one of the professional bodies which is covered here, for services given to their members. Then next comes, if you're into export, You get all these type of export related indirect benefits. That is also part of business head. Then while doing business, you may receive some benefits which may not be in monetary form, which may be in form of some perquisites, which may be in the form of some gifts. So all those are also taxable. So in short, any gifts or benefits received arising from your business activity is also taxable under PGBP. If you're a partner of a firm, the firm pays you interest, the firm pays you salary, the firm gives you share in profit. All these three are covered in PGP head. Only out of this, the profit that you receive is exempt in your hands because it is already taxed to the firm. But all these three are covered in your PGBP head only. Then nowadays, many agreements happen whereby your competitor may come and tell you, let us not fight, let us divide our area. You don't do business in my area, you do it in another area. And since you are agreeing not to do business in my area, I will give you a lump sum amount, which is called as non-compete fees. Then comes keyman insurance policy, right? So keyman insurance policy is a special type of policy taken out by business for the life of their key persons, which may include their employees, directors, partners, etc. So where upon the death of that employee, director, partner, whatever amount is received by the businessman from the insurance company, that is taxable here. And then there are these 2 points. Sushmita Beda, you are asking doubt about 9, but I have not explained 9. I have said that we will discuss that later on because it is slightly technical. As we go to further provisions, after studying that provision, when we'll come back, you'll understand it. So for the time being, I have not explained 9 and 10. So let us keep it aside for the time being, Sushmita. Anil, better, what you are saying, according to me, is not understood by me, but fine. For the time being, if you're understanding it like that, it is okay. Right? ठीक है. Yes, Sushmita.
Good morning, sir.
Good morning,
Yes,
madam.
sir. Also, I did not understand the language under point 2 of the section 20A.
Yes,
Point 2, we have at
compensation.
or in connection with the termination of his management or
But I
office or.
explained this. Na, I gave you a simple example, 2, 3 examples I gave you when I was explaining this. So I'll give you an example. So you are running a business. For example, you're running a restaurant. Now government comes and says that as per the new rule of the government, restaurants will be run and managed only by government, not by private persons. So you have to, by default or compulsorily, give the management rights of your business to the government. Second example is you are belonging to some Raja family, some emperor family, and you are having different palaces. Now, one of the palace is declared as a historical monument and it has been put in the Protected Monuments Act. Now, once anything is put under the Protected Monuments Act, like for example, you have Taj Mahal, you have various palaces from Udaipur, Jaipur, which since they are covered in the Protected Monuments Act and they are considered as palaces of importance to our country as a treasure, the management, the running of that palace again goes to the government. In all these cases, when one of these managing rights which you are having is now vested in the government, vested means transferred to the government pays you some compensation. That compensation is covered here.
Okay, okay, sir. So
Fine.
basically, for any termination or any modification, the business, if we are receiving any income, that also
Yes.
will get taxed.
So either they have completely taken away your rights or they have taken away your rights partly. So when it is completely taken over, it is termination. Termination means putting an end. So complete termination. Modification is some part of the rights are kept with you, some they have taken away. So whatever they have taken away, they will give you compensation for that. Correct?
Okay, yes, sir.
See, students, understand one thing. When you are studying a taxation subject, whether it is income tax, GST, you will find varied type of provisions. Why? Because taxation law has to be comprehensive to cover everything under the sun. Because if something is left out tomorrow, there will be a dispute over that. Now, when they are trying to cover everything under the sun, you may not have seen that thing practically in your life till date. So for you to understand that thing may be slightly difficult. Why? Because you have never had an exposure of that. So in such cases, you should understand it theoretically for the time being. That is what we call as academically. When you go into articleship, you'll find practical cases, so you'll understand more at that time. Okay? Let us proceed then. So now we are understanding the PGBP provisions, that is the debit provisions, credit provisions in detail. Now, before I go to this, there is one more theory point. Let me just cover that. It is also a query raised by, I think Anshul has asked this. So, what is this theory point? Now, when you are computing your business head income in accounts, if you remember, for doing accounts, the rule is you can follow two methods, cash basis or accrual basis. I hope you all know this, that even for preparing accounts, there are two methods. Cash basis means you will only consider those incomes and those expenses for which actual payment is done and received. So only those incomes are covered for which payment is received. Only those expenses are covered for which payment is made. That is what is cash basis. And second basis is accrual, which is also called as mercantile. What is this mercantile method or accrual method? We will consider all those income expenses which may actually not have been paid and received, but they belong to the current year. Like salary. Generally, salary of the month of March would be paid in the next financial year when April will start. But we will cover salary of March in this year only while doing accounting, while preparing P&L, because we follow mercantile, that is the accrual method of accounting. Now, there are two methods of accounting. Similarly, the question comes that when you are computing your PGBP income, which method you should follow? That is, while computing your taxable income, that is a PGBP income, whether you should also consider only those which are actually received and paid, which is cash basis, or you should cover also those for which maybe payment is not done, payment is not received, but they pertain to this year, which is the accrual or mercantile basis. So for this, the answer is given by section 145 of the Income Tax Act. What does 145 says? Out of 5 heads, 2 heads, one is PGBP and the other is other sources. For these 2 heads, it says that we have given option to the assessee. So either you can follow cash basis or you can follow accrual basis. It is your choice. So for these 2 heads of accounts, the option is given to you. So if you want, if you are preparing your books on cash basis, you compute income also on cash basis. If you are preparing your books on accrual basis, mercantile basis, you compute the PGBP income and the other sources income on mercantile basis. Correct? So this is what is provided in the Income Tax Act, section 145. Now this has some exceptions. Again, what are the exceptions? As we will proceed, I'll give you the actual examples. You will understand this. One of this we have just studied in section 28. List, what is that? That when you are exporter, you received some government benefits like subsidy, grant, cash assistance, the refund of the taxes already paid. So whenever you receive all these benefits, we have already seen in section 28 list that whatever indirect benefits exporters receive, that is covered in PGBP. That is, it will be considered as PGBP income. Now, what is this point says? The original section 145 says, I have given you a choice. I have given you an option. However, there is an exception given in 145B, which says that for some incomes, only cash basis has to be followed. That is, for these 2 incomes, you are not given a choice. For these 2 incomes, you will follow the cash basis. That is, they will be treated as income only when received. Out of this, in PGBP head, the amount which is to be covered on cash basis is the export benefits. So export benefits will be taxable to you only when it is received. It will not be taxed on accrual basis. I hope this is clear to everyone. Right? Anchal, I hope your query is also resolved. Now we go to our provisions in detail. So credit side, first is section 28. It covers business receipts, both direct, indirect. Now we come to the second section, which covers incomes from business head. That is section 41. Now what does this section 41 says? Section 41 says that under the PGBP head, you will cover one more type of receipt. What is that receipt? Now, interestingly, originally this amount is an expense or a loss of some prior period. So in past year, you have spent this amount or you incurred a loss. Like the simplest example is bad debts. So 4 years back, there was bad debts, and importantly, that bad debts was debited to your P&L. That is in the language of PGBP. It was allowed to you as deduction. Now, this is a very important condition. It should have been debited then. That is allowed as deduction. Now, what was allowed as deduction in past? If in the current year, you recover that amount or that expense is reimbursed to you. So what was debited in the past, because you were considering it as your expense or loss, interestingly, that amount gets recovered. Like best example is bad debts, which you assumed is your loss because that person has become bankrupt or insolvent. Your amount will never be received. So you treated it as your loss. Interestingly, that person comes and pays you that outstanding. So you recover the bad debts. Now, whenever this happens, that you recover some bad debts, which were earlier allowed as deduction, that is, they were debited to P&L. Now, since that amount is no more a loss, you have to reverse that entry. I'm speaking in the language of accounting concept. So what you debited because you assumed it to be a loss, now actually the loss not happened because the amount is received, recovered by you. So now you have to reverse the entry. So what will you do in accounts? You will show this bad debts on the credit side of P&L because you want to now consider it as an income. Similarly, PGBP says that since you treated this as a deduction, now you will consider it as an income to reverse that effect. So 41 is not covering anything very special. It is also what you have studied in accounts. That is, in the past, if there was any loss, which is now recovered, reimbursed, it will be treated as your PGBP income. So these are the two sections, students, which determine what items will come on the P&L credit side. So see, on the basis of this, I have made this P&L, which covers PGBP items as per the sections. So if your business is relating to goods, it will be sales. If it is relating to some type of professional service, it will be fees or charges. If it is transport, it will be freight. If you are into commission business, that is, you are an agent, it will be commission. If renting is your business, like you see big malls. So my business is constructing the malls and giving it on rent to various brands. So rent is also my PGBP income. So as per 28, these are the various receipts which will be covered under this head. And as per 41, if bad debts were debited earlier, now recovered, it will be considered as PGBP income. If you had paid some duties and taxes, which is now refunded back to you, it will be covered as PGBP income. However, in this, there is an exception that income tax refund is not covered in PGBP. Why? You will realize it after half an hour when we go to some important provisions of the debit side. Because what is the condition? As per 41, only those items can be considered as PGBP income which were earlier treated as PGBP expense. If something was not allowed in PGBP as an expense, today even if you receive that amount, it will not be considered as PGBP income, right? That is why income tax refund is not considered as PGBP income. Why? Because in the past, when you paid the income tax, PGBP did not consider it as expense. It did not allow deduction for income tax. That we'll study today when we study the debit side provisions. Correct? Now, there is one more section relating to credit side of PGBP. This section is 43CA. Now, basically, this section is for determining how much value you will credit in your P&L. So, as per section 28, we know that sales will be credited. That is, it will be considered as PGBP income. This is decided by 28. Why? Because you are in a business of particular thing. So, whenever you purchase, sell that thing, the sales will be considered as PGBP receipts. Fine. But what amount will be considered? That is decided by 43CA. But 43CA covers only one item. What is that item? You are a builder or a developer. And what is your product? Your product is land or building. So as a builder, you construct flats, offices, and you sell it. Or as a developer, you take a big plot and you divide it into small plots and you sell plots to people. Now, when you are a builder or a developer, so for you, your business goods are the land or the buildings that you are going to sell. Only for land building, you have 43CA valuation. What does 43CA says? Now, whenever you deal in land building, you have stamp duty, which says that you have to register your land building transaction with the stamp authorities. And while registering, they will charge you some stamp duty. Now, in this particular case, when they are charging you stamp duty, on what value stamp duty will be charged? Originally, the law said on the agreement value, what you are showing in your agreement. Now, what people did, in order to evade tax, in order to avoid tax, they purposefully started showing lower value in their agreement. Like, you did transaction of your land. So you had a plot of land, an ancestral property. You sold it for 5 crores. But on paper, on the agreement which you made with that person, you showed only 4 crores. So the intention was to evade a tax of 1 crore. Now, by showing less value, the buyer was required to pay less stamp duty, and the seller, that is you, were required to pay less income tax because your sales are appearing at a lower amount. In such cases, this new section was evolved, and the new section says, wait, what value you will take in P&L on the credit side will be decided by me. Now here, there are different possibilities. What are the different possibilities? So different possibilities are this. See, these what we discussed in the previous class, I will repeat again. So what are the different possibilities? Now I have shown two values here. One is the value as per your agreement. That is what you have shown in the agreement. That is this. And one is the value which is fixed by the stamp authorities. So now the stamp authority, that is the state government, has itself decided a value for your property, for the land or building that you are selling. Now, first possibility is your agreement value, that is the value you are showing in the agreement, is more than the value fixed by the stamp duty authority. So for example, you are showing 100 and the stamp value as per the stamp records is 96. Now, when the value which you are showing in your agreement is higher, there is no problem at all. Government says we will take this 100 as your sale value. Correct? Because here there is no chance of tax evasion. You are already yourself showing a higher value. The question or the challenge comes whenever your value is less than the stamp value. Now here there are two possibilities. Your value is less, but slightly less. In second scenario, your value is less, but there is a huge difference. Now in such cases where your value is less and the stamp value is more, now how to find out what value will be considered as sales? So for this, section 43 says compute an artificial amount. How is this artificial amount computed? You have to take 110% of your agreement value. So how much will be 110 of 100? So 110% of 100 will come to 110. Now compare this 110, that is this artificial value, with the stamp value. So 110 compared with the stamp value. Now, when you are comparing this artificial 110% value with the stamp value, there are two possibilities. First, this 110 is now more than the stamp value. Now, if this 110 is more, then they say you can take your agreement value only as sale value. So in this second scenario, again, what will be taken as sale value is 100. Remember one thing, 110 will never be taken as your sale value. 110 is only an artificial value for comparison. Now in the third scenario, what is happening? This 110 value is also less than the stamp value. Means the stamp value is exceeding your agreement value even by 110%. Now when the stamp value is exceeding your value by 110% also, now the law says in such scenario, you will have to take stamp value as the final value. So in such cases, while computing income, the value to be taken is the stamp value and not your agreement value. This is what is given in section 43 CA. Is this clear, students? Now there is a technical point in this, but first we will understand the basic part. Once you are clear with the basic part, we'll go to the technical part. Anybody, any questions, students? Because now what I'm going to explain is slightly technical in 43 CA. But before that, this basic point. Yes, tell me. Student, just allow me a minute. Till that time, you just go through this. If you have any doubts, you can ask me. 1 minute, please. Yes. Yes, students. So whenever 110, this artificial value is more than the stamp value, you will not take 110. So visual, you are right. You will take 100 only. So 110 will never be taken as your value. It is only a temporary value or an artificial value only for comparison. Correct? Vishaka, that is what is the technical point we are going to discuss now. Now, once you have understood this, there are two technical points which we have to further understand. What is the first technical point? Now, the first technical point is a practical possibility. What is a practical possibility? See, these stamp values are fixed by the government. Now, they are fixed not every day. Once they are fixed, they may remain constant for next 1 year, 2 year, 3 years. That is, the government may not be determining stamp value every year. It fixes the value once, and then that value is used for a period of time. Now, let us say, like what happened? Suddenly you had COVID, you had some war somewhere, because of which businesses got affected and there was some recession in market. I'm sure you all understand what is recession, where the market is running slow. Now, whenever there is a recession or there is any such things, like how you will observe, the share market fell. Similarly, in such cases, the prices of properties also at times fall. It happened during COVID. It happened here, that there is a fall in the price. So now it may happen that practically the prices have fallen because of such situation. Now, importantly, stamp duties are not revised because this may be a temporary phase. Now, in such cases, there is a possibility that genuinely the prices have fallen, so your transaction is happening at a low value, but the stamp value, since it was fixed earlier when the market was in boom, is very high. Now, in this third example, where we have fixed that the value to be taken for the purpose of computing income is stamp value. In such cases, this particular point will come. What is the point? That if you feel that no, stamp value is exorbitantly high and hence it is incorrect, it is not correct to take this stamp value. Why? Because this is a value fixed some time back and today the markets have fallen. So this value is not appropriate. Now, whenever you feel that the stamp value is exorbitantly high, the law has given you a choice. What is the choice? You can request your officer, who is called as the assessing officer, that is the income tax officer, to refer the valuation of this property to a specialized person called as a valuation officer. So valuation officers are valuation experts. So that person will determine the current market price of this particular property, and that person will give you a value called as valuation officer's value. So now you have a valuation officer's value. So you have your agreement price, which you have written in your agreement. You have a stamp duty value, which is fixed by the stamp duty authorities, that is the state government. And now there is one more value which is fixed or which is calculated by the valuation officer. Now this value you will get calculated only in this third scenario, where as per the law you have to take stamp value which is higher. Now whenever you have to take stamp value which is higher, you request the assessing officer, sir, please determine the fair market value of this through a valuation officer. Now, when a valuation officer is determining the value, which is our third value, the possibility is one, valuation officer's value is lower than the stamp value. Possibility two, his value is even higher than the stamp value. So both things can happen. When a valuation officer is calculating the fair market value, his value may be less than stamp duty value or more than stamp duty value. Now, what value will be the final value? So your answer was that you have to take stamp duty value in the third scenario. That is when it is more than 110% of your agreement value. You have to take stamp value. In such cases, you request the assessing officer to find out its valuation through the valuation officer, and the value given by the valuation officer is less. Now the law says if the value given by the valuation officer is less, you can take that value. So now in this case, my final answer would be 108. That is a value given by the valuation officer, which is less than the stamp value. However, if the valuation officer's value is even more than what the stamp value is, the law says don't take this value, now take the stamp value again. So the simple rule is whenever you are falling in the third situation, only in this third situation, you will go for this option, that is the value of valuation officer. And in that case, if valuation officer's value is lower, take that value because it is beneficial to you. But if it is higher, then let the valuation officer's value be ignored and you continue to take the stamp value only as the final value. Is this clear, students? So this is the first technical point relating to 43CA, that is what to be done where stamp value is very, very high. Clear, students? No doubts, no questions? Yes? Perfect with all? Okay. I hope everybody, this technical point is clear. Good. Students, kindly be responsive. You may in between raise your points. You may simply say yes, no, so that you are also not getting into a monotonity by only listening. And I also am aware that yes, whatever I am explaining is going through you, not going above you, right? So first technical point is this. Now there is interestingly a second technical point. Now both these technical points, that is this first one and the second one, which I'm going to explain, both these will be asked to you in the question mainly when you have the MCQ type of questions where case study is given. And in that case study, there are some questions for which there are multiple options. In the multiple option questions, you will be having one of these technical points as your question, right? Now, what is the second technical point? The second technical point is that we have to find this stamp value. This is very crucial because only after finding the stamp value, you compare it with agreement value or you compare it with 110% of agreement value and you find out the answer, that is what value to be taken. Now the question comes, which dates stamp value is to be taken? That is stamp value on which date has to be taken. Now why this question comes? This question comes because if you remember, I was mentioning just few minutes before that the government fixes the stamp value and then that stamp value remains same for 1 year, 2 year period. But after that, they will change. Now there is a possibility that this stamp value has just changed recently. Now, normally, whatever I have seen in past 25 years, the stamp value, whenever it changes upwards only. That is, the stamp value is always increased only. I have never seen a case where it is decreased. So the government, whenever they are revising the stamp value, changing the stamp value, it is always upward. Now, let us take a scenario. Today is 28th of May. The stamp value was changed by the government on 1st of May. That is few days back. Definitely, the stamp value before 1st of May was less and the stamp value which is fixed or revised on 1st of May is higher. Now, as a businessman, I will definitely try to take the stamp value, which was the older stamp value. Why? Because when I take older stamp value and do all this comparison, which we understood, definitely I will be benefited. Why? Because the older stamp value was less. Now, in such cases, what does the law says? Which stamp value you should take? The stamp value before 1st May or the stamp value after 1st May, that is the new stamp value. Now for this, I will give you an example. How I can take old stamp value? I will have to prove that this transaction of selling my shop or selling my flat, which I have constructed as a builder, has happened before 1st May. If I can prove this, then by default, there is no problem. I have to take the old stamp value, which is beneficial to me. Now, in this case, genuinely, I have sold this land building before 1st May. Genuinely means truly. So you had come to me somewhere in January, February, March, and we did the agreement and it is sold. No problem, no confusion. By default, old stamp value applies. Second possibility is you had come to me in the month of April. Now pay attention. So you came to me in the month of April. You wanted to buy a shop. I gave you the price. Let us say I quoted 5 crores. We negotiated and we finalized the price at 4.5 crores. Now 4.5 crores is agreement value. We'll keep that aside. Now when we saw or we checked the stamp value at that time was 4.65 crores. Okay. Now, when you finalize with me this deal in April, you said that, sir, the amount of 4.5 crores which we have finalized is very huge. You will require 2-3 months so that you can get a bank loan done and you can pay me the balance. I said, no problem. Do one thing. Since we are finalizing this agreement in the month of April, give me some token. Now see, this is the stamp value fixed. 4.5 is our agreement value fixed. Correct? Now, since you have confirmed me that you are going to purchase this property, I normally take a token and then I'll say, no problem, I'll wait for 2-3 months till your bank loan is arranged. So I have taken some advance. I have taken some token money. Now, whenever I have taken some advance or token, now comes this important question. What is this important question? I have only taken token in the month of April. My agreement happens somewhere in the month of June. So finally, we do the agreement. That is, I actually transfer the shop to you because you have paid me the entire amount of 4.5 crores. That is, our entire transaction is completed, closed. So I pay you, I give you the shop. So the final deal completes in June. Now, what has happened between these two dates? That is the date when you confirm the booking and the date when we close the booking or close the deal, is that in between this period, the stamp duty value was increased from 4.65 crores to 4.9 crores. Now, definitely, I will, as a businessman, prefer this stamp value so that either it is lower, so that will not be considered, or even if it is higher, lesser amount I will have to consider because the stamp value of 4.65 is lesser and it is beneficial. Definitely, the income tax officer will say, no, you have to take this stamp value only because a higher stamp value will result in higher income and higher tax. Now for this, what does the law says? The law says that when any such scenario happens, that you have done booking earlier, but the final deal happens later, and in between these two dates, the stamp value has changed. Which stamp value is to be taken? The law says we will allow you to take the old stamp value provided this token which you have given should be given by some banking channel, then we will allow you to take the old stamp value. If you have given this token in cash, you are gone. If you have given in cash, then I will not take the old stamp value. I will take the new stamp value. So what is this second technical point? The second technical point is about which dates stamp values to be taken. This point is required or important only where your transaction had happened before the change in the stamp value, but it was completed after the change in the stamp value, and between this period the stamp value has increased. You can take the old stamp value, that is the date of stamp value will be the old date when you had actually booked this property by giving me advance token. Condition is it should be via banking channel. Now what is banking channel? You should have given me this token or advance by way of account pay check or by way of some online medium, UPI, RTGS, NEFT, online banking, or by swiping your card, means through some banking mechanism. If you have given me this amount in hard cash or even by bearer check, see bearer check, cross check, all these are considered equivalent to cash. So if you have given me this payment by hard cash or even by bearer or simple cross check, I will not take the old stamp value, I'll take the new stamp value. But if you had given me this advance, either by way of account pay check or draft or by any online medium, then I will take the old date. This is, students, the second technical point in 43CA as to which dates stamp value is to be taken. Fine. Now see, as we will proceed, you will find things becoming slightly technical. But everywhere what I'll do, first I'll give you the basic understanding. Once the basic understanding is through, then slowly we'll move to the technical understanding. So these are complete provisions of the credit side of PGBP head. I hope this is clear and understood by all. Right? Now we will take a 10 minutes break just to give ourselves a mental break. And then after this, we will come back to our provisions of the debit side. That is the expenses side. Right, students? Before that, there is one question by Anshul. Sir, once stamp value is decided by government, it always increases. See, till date, I have seen increase only, beta. So we are going by this presumption only that it is increased because this is what happens generally, right? Okay, students, let us have a break and let us reassemble after 10 minutes. Now I have one more question now, which is from Gayatri. She's asking, sir, isn't stamp duty a tax? Yes, but a stamp duty is a tax levied by the state government. Whenever you register a property, you have to pay stamp duty. Different states have different rates. So some states have 6%, some have 3%, some have 7%. So whatever is the rate applicable to your state, you have to pay stamp duty on the value of that property which you are registering. She's asking, why is it considered as income? But a stamp duty is not considered as income. Now, stamp duty is at the rate of, as I said, 5%, 6%, 3%. Now, this percent has to be calculated on some value. That value is depending upon your agreement value, which you are showing in the agreement, or the value which is fixed by the government, state government, for the purpose of stamp duty, which we are calling as stamp value. So here, what we are considering in our income calculation is the stamp value, not the stamp duty. Stamp duty is an expense. It will come on the debit side of your P&L in your accounts. Here we are considering the credit side, and here we are trying to discuss what value of the property should be taken for determining income, whether your agreement value or the stamp value fixed by the state government. Right, beta? Vishakha is saying, sir, so value will be taken for comparison only. Exactly. Perfect. What is SV and SDV? Vishakha, you have written SV, SDV. Yes, Mohit. When we'll go to capital head, you'll find that the same provision is given under capital gains also. Vishakha, but a stamp value, stamp duty value is one and the same. So short form is SV or SDV, but it is same. So the value which is fixed by the state government for computing or determining the stamp duty is what is called as stamp value or stamp duty value. Correct, Vishakha? I did not get your question, Mehak. You may unmute and explain me what is your question so that I can answer it. So students, this point, that what if this land building is not my stock in trade? What if it is my capital asset? So let us say for a builder, the shop or the flat which the builder is selling is a stock in trade. So for builder, the purchase sale of flat shops comes under PGBP head. But for you and me, whatever shop flats we are owning, for us it is a capital asset. In that case, firstly, this chapter of PGBP itself will not apply, because whenever you and me will sell this flat or shop, for us the income will be covered under the head capital gains. But yes, as pointed out by Mohit, this particular provision, what you studied in 43CA for sale value of land and building, a similar provision is covered in capital gains, where we study it in section 50 capital C. So 50C of capital gain and 43CA, both are same to same. What I am explaining now, this will be repeated again in capital gains, again for the sale value of land and building. The only difference is that if you are a builder developer, the land building is a stock in trade. So it will be covered here in PGBP. You will apply 43CA. If it is a capital asset for you, like you and me, when we are selling any land building, so for us, similar provisions of what should be the sale value will be covered in 50C. Okay, Visual is asking, sir, we report closing stock at what value? See, in closing stock, stamp value is never considered, because stamp value is an artificial value fixed by the government only for computation of duty. So for closing stock, you remember our AS2, Accounting Standard 2 provisions. It says you have to take your cost or the market price, whichever is less. Correct? So it will be generally your cost. And if by chance, because of some specific event like I explained, COVID or any of these war situations, if the market prices have fallen below cost, that year's closing stock will be shown at the market price. But for all these purposes, stamp duty will never be considered. So in stock, you don't take stamp duty value. It is only for determining the sale value, that also only for the purpose of income tax, not for the purpose of accounts. In accounts, the sale value will remain your agreement value only. Fine, students? Okay, great. Now we come to the debit side of your P&L. Now, when I'm saying debit side, it means we are talking about expenses. Now, when you talk about expenses, when we read Income Tax Act, we found only 3 sections for incomes, that is credit side. But we have more than 50 plus sections for the debit side. In fact, the major part of PGBP chapter is covering the expenses side provision. Now, when I say 50 plus provisions, suddenly you will feel, oh, the debit side will be very tough. Not at all. Because out of the 50 plus provisions, more than half provisions are covered in Part A and few provisions remaining are covered in Part B. Now, what is Part A? Section 30 to 37. These are the sections which gives you the conditions that you have to satisfy so that the expenses will be allowed in PGBP calculation as a deduction. Now, these conditions, what are given in the law, are repeated in every section. So there are multiple sections, even though you see 30 to 37, but when you actually see the section numbers, there is not many ABCD subsections. So effectively the provisions are more than 25, 30 only in this 30 to 37 sections. But in all those provisions, what they have done, they have taken each item, like I'll again show you here. See, you'll see different section numbers here. Why? Because for different expenses, different section numbers are applicable. Now, when you read each of these sections, which is for different expenses, they have made different sections. They have given some conditions. You have to satisfy those conditions. Then the PGBP head will allow your expenses as deduction. Now, when you read all these sections, independently, they may be 25 plus, but I have combined them together into what I call as golden rules. What are these golden rules? Golden rules are those conditions given. So as I said, some conditions are given. You have to satisfy those conditions. And once you satisfy, that expense becomes eligible for you as reduction in PGBP. Now, what is interesting to note is there are only 4 conditions given in all these sections. The 4 conditions are to be satisfied. You satisfy them, that expense is allowed. However, interestingly, for few expenses, all 4 conditions need not be satisfied. 1 or 2 conditions they have excluded. Means for those few expenses, you need to satisfy only 2 or 3 conditions, not all 4. Means for all 4 conditions are not required to be satisfied for each of the expenses. This is where comes the point of exception. So what I've done, instead of taking each section one by one, which becomes very boring, very monotonous, I have taken those 4 conditions, which I call as golden rules. And then there are few expenses for which that condition is not applicable because the law does not require you to fulfill that condition. I have given them as exceptions. Means general rule is for every expense, you satisfy all the 4 conditions. But exception to this rule is few expenses, you need not satisfy that condition. Still, the expenses are allowed as deduction. We will call them as exceptions. Now, firstly, I'll tell you what are broadly those four conditions. First golden rule or first condition is when I will allow you that expenses under PGBP head, if that expense is related to the business. In short, it is a business expense, not a personal expense or not any other head expense. Simple condition. Second, the expense is not a capital expense. Now, as a student of commerce, you understand this, what is a capital expense, what is a revenue expense. So the second condition is the expenses are not capital in nature, they are revenue expenses. Third condition, since we compute income for each financial year, the expense which you want to claim as deduction should be of the current financial year for which you are doing computation. So for us, presently, in our exams, it is financial year. So what expenses you can claim as deduction? Those expenses which are of financial year 25-26. And then the fourth condition, the expenses should not be illegal. It means the expenses should not be such which is prohibited by some law, forbidden by some law, or which is something as an offense, like giving bribe is forbidden by law. Then doing smuggling is what is forbidden by law, or it is an offense. So if you do any such things, expenses for such items which are illegal, which are forbidden by law, are not allowed. Logical. You cannot be allowed illegal expenses in income tax because then it will be indirectly legalizing those expenses if I allow it under income tax. Correct? Now, these are those four golden rules. What are they? First, expenses should be related to your business. Two, it should be revenue in nature. Three, it should pertain to this year. And four, it should not be for anything which is declared as forbidden or as offense. All the four conditions you satisfy, that expense is allowed. So I'll give you example. So when we are reading P&L, what is my first expense given? Cost of goods sold. Or wait, I'll take you to the practical question. Now see, you have this type of question. Now, whenever you want to decide whether a particular expense is allowed or not, what you have to check? You have to check these four conditions. So let us go one by one. What is the first expense? The first expense is salary. Is it related to business? Yes, I'm paying it to my business employees. Two, is it of current year? I'll have to check what salary figure 1,60,000 given in the question, whether it is of current financial year. Three, is it revenue in nature? Answer is yes. Salary is not a capital expenditure. Four, is paying salary any type of offense? Answer is no. In fact, it is a very legal payment. So you satisfy all these four conditions. That is, it is covered under business because it is business expense. It is related to current financial year. It is revenue in nature and it is not illegal. All expenses are, sorry, all conditions are satisfied. So salary becomes an expense which PGBP head allows. Second, you have paid rents, your rates and taxes for your office building, for your factory building, for your godown. It is allowed as deduction. Yes. Why? Is it business expense? Yes. Revenue in nature? Yes. Current year? Yes. Is it offense? Allowed. Now here, if you remember, we have adjustments like this, that rent rates taxes include some amount which is relating to property which is let out. Now, the moment you read this adjustment, you find that this 8,000 will not be allowed. Why? because it is not satisfying my first condition. What was first condition? Related to business. This is not related to business. This is related to HP head. Similarly, in previous sum, there was repairs which was for your personal house where you are staying. There was salary which was again your personal expense because it was paid to your house employee, not business employee. And in such cases, if you remember the first question's answer, we disallowed these expenses. Why? Because out of four rules, the first rule itself is not satisfied. What is my first rule or first condition? The expense should be related to business. If it is related to any other head, or if it is my personal business expense, it is not a business expense. I will not allow it as deduction. Now, you have paid commission. Is it for business transactions? Yes. Is it related to the current year? Yes. Is it revenue nature? Yes. It is not a capital expenditure. Is it any type of illegal activity? No. Again, it is allowed. Advertisement. Have I done it for my business products, for my firm's goodwill, for doing some type of brand launch? Yes. So it is business. Two, is it related to current year? Yes. Is it revenue in nature? Yes. Any offense, any illegality? No. All conditions satisfied? Allowed. Similarly, depreciation of business asset, legal expenses, conveyance and traveling expenses, stationery, bonus given to employees, administrative expenses, repairs, interest on loan. All these, check the four conditions. Are these expenses of your business? Yes. Is anything personal? That will be given below. If nothing is given about personal, we assume it is business. Two, from the name you can find out whether it is current year, whether it is revenue in nature or not. Three, whether it is current year or not. Again, if nothing is given in the adjustment, you presume it is current year. And fourth, by the name again, you will have to identify, is this illegal? If you conclude it is not illegal, then all four conditions satisfied. The expenses are fitting in section 30 to 37. Some section they are fitting. For the time being, you need to not know the precise section. That is fine for the time being. For the time being, today you have to only understand the logic and the applicability. The next part is learning section number that you can do over a period of time. So these expenses are fitting between 30 to 37. Some of the provision they are fitting in because they are satisfying all the four conditions, and hence they are allowed in PGBP head as deduction. This is clear, students. Tell me if you have not understood anything. Now I am linking the theory part, the provision part with practical question to give you an actual feel. So for each expense, you will check these four conditions. Done? Understood by all? Very good. Conveyance means traveling person. In accounts, you would have read this. For traveling expense, there are different names: traveling, conveyance, freight. So whenever you incur traveling expense, they are given by these names. Yes, Mehak. So you have to check whether your expense is fulfilling all these four conditions. Once it fulfills, it is allowed as deduction in PGBP, means PGBP will also treat it as an expense in simple words. Or in other words, you can debit that in your PGBP P&L. Correct? Now comes the interesting part. Now, if for all expenses the same four conditions had to be satisfied, then what was the need of creating section 30 to 37? So many sections. And again, I repeat, by number, though may appear to be 7 or 8 sections, actually there are 25 plus sections because there are many subsections, then there are A, B, C, D in this. Because see, there are so many expenses. So for different expenses, if they are creating different sections, it will exceed 25, 30. Now, point is, if for all expenses the same four conditions are required, what was the need of making so many sections? They could have made one section, and in that one section they could have written the four conditions, and that section they could have said for all expenses these four conditions are to be satisfied. What was the need of creating 30, 31, 32, 32A, AB, AC, 33, 33A, B, C? Why so many sections? Because for some of the expenses, they have relaxed one or more of these four conditions. That is, for some expenses, they do not want you to satisfy all four. Even if you satisfy a condition or two or three, it is allowed. That is, all the four conditions need not be satisfied for some expenses. What are those expenses? That is what I have put down as exception to that condition. So as you can see, first condition is your expense should be related to business. Fine. But now I have written exceptions. What are these exceptions? For some expenses, they have said that even if you do not satisfy this first condition, it is fine. It is allowed as deduction. Now you have to remember the names of this expense, that for which expense that condition is not required. The expense will be allowed even if you have not satisfied the condition. Okay, let us understand them. Now, our first condition is, first golden rule is, your expenses should be related to the business. It should not be personal, or it should not be related to any other head. Simple condition. However, there are three expenses, 1, 2, and 3, for which even if these expenses are not related to business, I will give you deduction. These may be personal, I'll give you deduction. Now your question will be, sir, why are you allowing personal expense? Is there a logic? Why is the act allowing personal expenses? The answer is yes. If you understand, you will find that these expenses are of national importance. Now, if something is of national importance, definitely the government want to promote it. So they say that you do this expense. What is your benefit in doing this? You will get deduction in PGBP. To that extent, your business income will be lower because I am allowing you deduction. And once your business expense is lower, your profits and taxes are lower. So you are benefited. Now, what are family planning expenses? Now, family planning is simply control on the birth rate. As you all know, today India is number 1 in population. Now, this happened just recently, but the signals were being received right from 1980s and 90s that India's population is growing very fast. We need to control it, otherwise it will be a problem for the country to run, because there will be a lot of pressure on your economic resources. It will be very difficult for the government to provide proper water, proper sanitation if the population explodes. So what the government did, at their end, they run various programs in which, if you would have seen, there were many television ads, many in smaller villages and cities. They used to do some paintings on the walls, educating people about the need of family planning. But at the same time, the government thought of a brilliant idea. They thought, or they observed, that in a company which is running a factory or some big business, at one place you have 1,000, 5,000, 10,000 employees at one place. And if I am able to educate them, if I am able to explain to them what is the problem with high population, how to control population, how to maintain your family small, if I can train them, if I can educate them, then it will be very beneficial for the country as a whole because the population will be controlled. And let me tell you, all these efforts of government are showing results. Earlier, the rate of population growth in India was averagely per family 3 kids. Now it has come down to 1.9 on an average. And it is projected that maybe after more 10 years, it will be only one, the average number per family. In fact, latest, if you see, presently, many newly married couples are only having one child. So over a period, this 1.9 will also come down to 1. Now, this has happened because of all these actions taken by the government. Now, what is this point? Now, here, this special relaxation is allowed only if you're a company. So if you're an individual partnership firm and you are doing family planning expenses, I will not give you deduction. But if you are a company and you are doing family planning expense, now let me tell you what is family planning expense. So family planning expense will cover expenses on conducting training workshops, expenses on conducting lectures and seminars for your employees, in which you will inform them, you will train them, you will guide them about the role of family planning. So for conducting such programs, such seminars, such training workshops, whatever expenses you incur, that is family planning expense. Now let me tell you one thing. Family planning expense is never related to business because it is not for running the business. It is something social. It is for the social benefit. But since the government wants to promote this because growing population was a national problem, it was the one of the biggest concerns of our government at a point of time in 1980s and 90s. That is why this particular section, as you can see the section number, it is 36 subsection 1 clause 9. This was added in the act, and the act said that if you're a company and if you're running these training programs, these awareness programs, whatever expenses you incur for doing those programs, I will give you deduction, though it has no connection with your business activity, but it is for a national cause. Correct. Second is scientific research. What are these expenses? Let me tell you the simple word for this, what we all know. We call it as R&D expenses in accounts. That is research and development expenses. Now, what is this R&D expenses? R&D expenses are expenses where a business is conducting some research, either for invention of a new product or for improvement in the existing product. Like, I'll give you an example. The most common businesses who are doing R&D on a regular basis and on a big scale basis is all pharmaceutical medicine companies, because they have to continuously evolve new medicines considering the new types of problems faced. Secondly, nowadays, this R&D has become very common in other businesses also, like all these motor vehicle businesses. They are extensively doing research, one, for finding out a parallel option for petrol and diesel vehicles, like you have the EV vehicles, You have some hydrogen run vehicles. So these are all developed through R&D. Second, for improving the design, the looks, the performance of your existing models, also they keep on conducting R&D. So there is lot of R&D happening in different businesses. Now, importantly, where you are doing R&D for your own business, there is no problem because you are satisfying my condition of expenses being related to business. Then why is this exception? The exception is again because the government wants you to make payment to outsider approved organizations. What is this outside approved organization? I'll give you example. You have 100% heard the name ISRO, our India's space research organization. Second, you have heard Bhabha Atomic Research Center. All these are an outside approved association. Outside means outside your business, means they are not your business association. They are maybe some type of laboratory or some type of college, university, organization which is approved by the government. Now, again, you will understand this point that whenever a country wants to grow, a country also has to do a lot of research in various fields. It may be defense, it may be agriculture, it may be space technology, it may be today's AI. For all this research, the government has established various bodies. It may be research laboratories or research colleges or associations. Now, for running these bodies, lot of expenditure is required. Now the government says, if you contribute to such outside agencies, and most importantly, why is put in this exception? Because these outside agencies, the research they are doing, they have no connection with your business. Like today, I give 1 lakh rupees to Bhabha Atomic Research Center. This has nothing to do with this, but it is of national importance. Yes, sir. Yeah. So I was saying, I think there was some net connectivity issue. So I was saying, when Bhabha Atomic Research Center or ISRO or any of such government-backed organizations are doing research, it has nothing to do with my business, but it is of national importance. So the exception is that whenever there is some scientific research happening and it is done by some outside organization, outside means I am not doing it, some other organization body is doing it, but most important, it is approved. That research, that body is approved by the government, then whatever payment I made to such approved bodies, earlier, as you can see, there was higher deduction. Now all that is removed. So to whoever I'm making the payment, now for you, it is easy to remember. Only condition is these outside bodies should be approved by the government. If they are approved, whatever payment I am giving to them, I get full deduction. Full means 100%. Now, this is the first provision which is different in the new scheme and old scheme. This deduction of scientific research expense to outsider is not allowed in the new regime. It is not allowed in the default regime. So when you are solving sums by default regime, you will not take this deduction. Only when the question asks you to do or solve the sum under the old regime, you will take this deduction. So this is our second exception. Now, third exception is donation. Now, we all know donations are for personal reasons, for some social reasons. What is the rule relating to donation? Now, I'm talking from the practical exam perspective. If in the sum they have only said that you have paid donation, nothing else is given. After that, only donation word is given. It is not allowed, disallowed under PGB. So deduction will not be allowed. Second possibility, the question says you have made donation, but the donation is under one of these sections. Now, these sections are obviously of Income Tax Act, and these sections are made under Income Tax Act to allow deduction for these donations. But let me tell you, donations made as per these sections are also not allowed under PGBP. They are allowed, but under Chapter 6A, that is deductions from gross total income, GTI. So these are called as Chapter 6A deductions. These are allowed from gross total income. These are disallowed, not allowed under PGBP. So only word donation is given, not allowed. Donation is given under 80G, 80GG, etc. Any section of 80 donation is given, it is also not allowed. Now you'll say, sir, then what is actually allowed? Only where the donation is given under section 35. That is what is allowed under PGBP. Same reason what I gave above. Why? National cause. What are these donations? So today prominently two donations are what are covered in section 35. First is donation for agriculture extension. Government is very strongly working on improving agricultural methods, improving crop yield. Now, recently they have started the millet mission. Recently they have started agriculture without use of any type of chemical fertilizer. So for all this, lot of research is required. Again, the government wants you to donate to such research, even though it has no connection with your business. Like if I'm in CA practice, agriculture extension has nothing to do with my business as such. Second important thing which government is promoting very aggressively is skill development. See, India has one big advantage. It is having high population, which is also advantageous. Why? Because today, India is that country whose average population is in the youth. There are other countries, the so-called developed countries, the so-called advanced countries, Germany, Japan, etc. The problem with these countries is their majority population is about 50 or 60. Now, such population cannot be considered as a working population because of their age, health condition, etc. That is why for these developed and advanced countries, there is a problem in future that because their majority population is in old age, there will be a time that there would be not many people left in the country to run that country. Fortunately for India, the situation is reverse. We are a highly populated country, plus our population majority is in the working age group of 20 to 50. This is where India has an advantage. But to make this as an advantage, this population should also be skilled and trained. So again, government is running multiple skill development programs, workshops, for which if you are giving donation, that skill development may not be related to your business. The skills that they are providing has nothing to do with your business. Still, since it is for national benefit, if you are making this donation, it is allowed as deduction. Earlier, this donation was also allowed 150%. Now, all donations are 100%. So these are the three expenses which I am calling as exception to rule 1. Why? because for these three expenses, even though they have no connection with your business, even though they are not related to your business activity, still you get reduction. Correct, students? First rule and its exception. Now the second condition. Now we all understand what are capital expenses, what are revenue expenses. So I need not explain that again. Importantly, when you are computing PGBP income, we all understand that the business income is always a revenue income. So PGBP head is a revenue head. So what should be allowed as reduction is only those expenses which are revenue, not capital in nature. Hence, the second condition put in the law is that we will allow a deduction only if the expenses are revenue. Now again exceptions. Now here interestingly, in exceptions, what they are saying, in few cases, which are the exceptions here, we will allow you capital expenses also. That is why they are exceptions. So rule is all expenses which you want to claim as deduction should be revenue. This is the general rule. But then the special rule is that in few cases, capital expenses will also be allowed as deduction. The next is asking family planning expenses is rural area is allowed. See, here area is not important. Here who has done the expense is important. If this family planning expense is done by a company, whether it is in rural or urban area makes no difference, it will be allowed as deduction. Now, what are the expenses where capital expenses are also allowed? Again, family planning. Again, scientific research. Now, what is this? Now, what is family planning? As I said, for your employees, you are conducting some workshops, some trainings to educate them, to make them aware. Now, for conducting these trainings, you require a LCD projector. Or nowadays, the new trend, you have that huge size TV. So nowadays, in all the training centers, coaching classes, they are not using projector anymore. They have all installed a huge size TV, a wall size TV. In fact, nowadays in many news channels also, they show you their some discussion they write on the board, which is a electronic board like a television. Now, all these are done wherever you are doing any type of training or education activity. Now, let us say a company, since it is regularly conducting these training workshops for its employees, it has purchased the projector. It has purchased that 3.5 lakh rupees TV for using it in all the training activities. Now, this is a capital expenditure. Now, interestingly, for companies, if they are doing family planning, revenue expenses are allowed and even capital expenses will be allowed. The only thing is you can claim it in 5 installments by taking 1/5 every year. So this TV which I have purchased, I'm a company, I have purchased this huge size TV for 3.5 lakhs to be used for doing the training programs. So this 3.5 lakhs divided by 5 will come to 70,000. Every year, I will claim deduction of this 70,000 piece. Second, scientific research again. Now, what is this scientific research? Where I am doing in-house research. Now, the above point was where I'm making payment to outsiders. Here, I am doing research myself. Now, this is where I create a laboratory of my own. Now, all these big companies which are doing research, especially pharmaceutical companies and all, they have their own research labs in which they keep on testing different medicines. Then once they make a formulation, what will be the impact of that? So they trial it on monkeys, they trial it on rabbits, they try it on mouse, and then they do human trials. And then finally the medicine is launched. Now, for all these things, the company, the businessman has its own in-house scientific research laboratory, etc. Now, whenever you are doing research yourself, which is called as in-house, Again, you may spend revenue expenses, that is recurring expense, or you may spend one-time expense. Now, what could be one-time here? For doing research, you require some equipments. Like if I give you a very simple school example, you require that magnifying equipment, you require different test tubes, different flasks. So many gadgets are required for doing research. All these are capital expenses. So capital expenses done for doing in-house scientific research is also allowed. Third, we are going to study some special businesses under section 35AD. What are those businesses? That we'll study later. But for the time being, just keep in mind that if you are doing a special business which is under 35AD, that is the names of those special businesses are under 35AD, then for such businesses, they can claim deduction even for their capital expenses. So interestingly, why these businesses are considered special by the government? Because these businesses are again developing overall economy of the country. These businesses are supporting some government objectives, like it covers housing construction, it covers construction of highways. All these businesses are covered in 35AD list. Now, when you are engaged in any of these businesses, which is 35AD, so let us call them as 35AD business, you are given a special benefit of even claiming capital expenses as your deduction. So revenue expenses all are claiming, you can even claim capital expense. Now the third condition. Now what is the meaning of this third condition? That since you are doing computation of financial year 25-26, so all expenses that you are claiming should also be of 25-26. So neither past period expense nor future expense. This should not be covered. So what should be covered is only the current year expense, not the past period or the future period. This is what this point means. Again, exception. In some cases, rather only in one case, the law says we will allow you future period expenses also. What are these? Only one expense, that is provision for gratuity. So where you are having employees, you all know that there is a Payment of Gratuity Act. Now this is old act, it is now merged with the labor codes. So you have to pay gratuity to the employee whenever the employee retires. Now that will happen in future, but accounting standard says you should start creating provision from now for this future expense. Now interestingly, when you are creating a provision, you are actually not incurring the gratuity today. You are just keeping that much money aside. So technically speaking, it is not your expense. Expense will happen in the year when in future the employee will actually retire. But special provision or the exception is that for only this one expense gratuity, whatever provision you have created, that will also be allowed as deduction. But we will study some conditions and restrictions later under 40A7. If you satisfy those restrictions, you can even claim deduction for this future expense in the current year. Then the second type of exception is where I allow you deduction in the current year of some prior period expense. So the expense pertains to 1920, the expense pertains to 23-24, but I am allowing you to claim in 25-26. So that is why it becomes exception to our rule. Now, what are these expenses? For this, again, you have to understand the logic. Same expense, family planning. Now, if you recall, we just studied that for family planning, capital expenses are also allowed. The only thing is that it is allowed in 5 installments. Now, what has happened? You have purchased some capital asset for doing family planning, like that used TV for 3.5 lakhs. This was purchased in 23-24. Now you can claim deduction of this TV capital cost for 5 years. So 1/5 in 23-24, then 1/5 24-25, 1/5 in 25-26. So in current year also, you are claiming that 1/5 capital expenditure, but interestingly, it was incurred 2 years back. But since the law has allowed you to claim that 1/5, so you will be claiming every year. So automatically in current year, I am allowing you 1/5 of some old period expense. So this becomes our first exception where in the current year, I am allowing you some old period expense as deduction. Second, scientific research we have again seen. Now in scientific research, what is covered over here is preliminary expenses. Now we all understand what is preliminary. So preliminary means even before the commencement of your business, you have done some scientific research. Now here they have kept a time limit. How much before? That is 3 years before commencement of business. So before starting of your business, if in 3 years before the starting of business, if you are doing some research, now this generally happens. Any new business when it is to be set up, it first does R&D. It develops some new type of software, some new AI tool, and with that, it starts the business. So whatever expenses you have incurred in the past, even before commencement of business, that you are allowed to claim full in the current year. That is the year in which you start the business. So again, it is an example of preliminary expense. Why? Because I am allowing deduction of some earlier period in the current period. Now, similar to scientific preliminary, you may have other preliminary, which is general. General means what? In general, whenever you are starting a business, many times for setting up a business, initially you have to do some expense, which accounts also considered as preliminary expense. Income tax says we will also allow you preliminary expense, and interestingly, similar to what you do in accounts. Even in accounts, whatever are preliminary expenses, you take 1/5, 1/6, 1/8, something is given in the adjustment, if you remember, and accordingly, you take deduction of those past period preliminary expense. Same thing is given over here. In income tax, you have section 35D, which deals with preliminary expenses. So the expenses are incurred 3-4 years back, but I'm allowing you to claim it every year, 1/5, 1/5, 1/5. So again, some past period expense is allowed in the current year. Now, what are the expenses which are covered here? One is general preliminary, which we are going to study in 35D. Second, when your business is formed by amalgamation demerger. Again, first you did amalgamation demerger of some existing company, and from that amalgamation demerger, your company was created. So you incurred expenses for doing this amalgamation demerger even before your company was created. So again, it becomes past period expense allowed to you 1/5 for 5 years. Similarly, you have given VRS to your employees. When you give VRS to your employees, you ask them to leave early before their retirement. And for doing that, you give them a lump sum amount, which is called as VRS compensation. This VRS compensation is also allowed to you 1/5 over 5 years period. Then comes preliminary expenses for mining. Now, if you're into mining business, preliminary expenses are allowed over 10 years period by taking 1/10. See, in all other cases, it was 1/5, but for preliminary expenses of mining, it is 1/10. Just allow me a minute, I'll plug in the charger. So for mining industries, whatever expenses they have incurred before commencement of their business, they can claim the deduction in 10 years by taking 1/10 every year. Now, besides this, there are two more expenses of past period which you allow in the current period. But for these two expenses, we'll have to first study these sections. These we are going to study in our next part. So when we'll study those sections, I'll come back to this. So for the time being, I'm keeping these two expenses aside. Now, this fourth condition is very interesting. Interestingly, originally in the income tax law, this condition was not there. Then happened a real life scenario. I'll not give you the actual name because it may not be correct to take somebody's name. But in 1990s, even if you see the movies of that time, you will know that at that time there was a big influence of underworld and all these Dawood Ibrahims and all on our film industry. So they were investing in film industries. They were as good as producers of various films, though it was done secretly, not directly their name was used. So they used to finance somebody else and that person's name was used, but it was actually of some underworld person. Now, in order that different actors agree to act in their movies, these people were threatening them. Now, I'm giving you a real life scenario where what happened in those periods, there was also a concept called as protection money. What is protection money? These underworld people used to by mail or by letter, because in those years there was no WhatsApp, there was no Instagram. So through mail, through letters, they used to threaten you, saying that if you don't pay me 5 crores, I will shoot you. If you don't pay me 5 crores, I'll throw acid on your face. Now, please understand, for any film celebrity, their face is very important. So they paid protection money. This 1 crore, 5 crore, whatever was demanded was called as protection money. Now, there happened a real life case where one of the very reputed film stars, while computing its PGBP income, showed this amount of 1 crore, 5 crore paid by to that underworld person as a business expense. And if you see, interestingly, it satisfies my first three conditions. What? Is this payment related to business? Yes. If I don't give this money, either I will be killed or they will damage my face or something, because of which my acting career will stop. So it is related to my profession of acting. Yes. Two, is it for the current year? Yes. Revenue? Yes. Recurring every time I have to pay. So all the basic conditions which we have studied till now were satisfied. So this person, this film star, claimed that expense in his income tax returns. Now this returns, when they were checked by the income tax officer, the income tax officer said, how can you take deduction of this? Sorry, not allowed. So the matter went to the court. And interestingly, the court, while interpreting the Income Tax Act of that period, said that yes, you can claim deduction. Why? There is nothing written in the law that you cannot claim this deduction. What conditions were given? It should be related to business, it should be current year, it should be revenue. So it is allowed. However, even though the court observed this, while writing the judgment, it said that even though strict interpretation of the law is it should be allowed, but if I go by the logic and if I go by the societal considerations, such payments should not be allowed because they are anti-social. If we start allowing such payments, it will be indirectly Income Tax Act legalizing this activity of threatening and getting money, which is illegal. So the Honorable Supreme Court, in their judgment, gave directions to the government to bring that amendment in the act. Otherwise, it would have been allowed under income tax. Now, because of that one case, this particular condition got added. And now it has become part and parcel of your income tax law that you will be allowed deduction. Obviously, first three are the main conditions, but fourth is a very important condition. Even though you have satisfied the three and it is part of your business, no problem. But if that expense relates to any activity which is illegal, which is forbidden, which is an offense, then you cannot take deduction. So let us say common example is bribe. So to get a business contract, I am bribing the person who is releasing the tender and who is finalizing the tender. So I bribe that person, I bribe some politician to pass some law in my favor, or I give bribe to any of the officials so that some favorable benefit to my business can be achieved. So whenever I do on such payments, first three conditions are satisfied. If you observe neutrally, you will find that all three conditions are satisfied. But still it will be disallowed because of this fourth condition. This example I already gave. Then many times when you're involved in such offenses like doing smuggling, tax evasion, and you are caught, you are levied penalty. Now, interestingly, what people started doing, like somebody is doing smuggling, out of 10 times, 2 times when the person is caught, the person has to pay some penalty. They were claiming this penalty as a business expense. Why? Because my business is dependent on import export. For doing import, I'm doing smuggling. And when 2 times I'm caught, I'm paying penalty, but it is related to my business because my business is of importing and selling these goods. But the law said, sorry, since this expense of penalty was related to an act of smuggling, which is an offense, I cannot allow you deduction of this. So what will be disallowed because of this fourth condition is all such payments which are illegal, which are treated as offense, which are forbidden under any act of India. Now, interestingly, in this, when we say penalties will not be allowed, but at the same time, there are some penalties which will be allowed for the same reason that they are not offense. Please understand the difference. Every penalty which is imposed on you is not necessarily because what you have done is an offense. It may be your mistake. You may not have complied with some condition given. Like simple example, you park your vehicle in a no parking area. You are put some fine. You do not do something on a particular date. You miss that date, you are put some penalty. But are these fines and penalties imposed because you did something illegal, because you did something which was forbidden by some act? Answer is no. Parking on a wrong side is not correct as per the law. But is this also considered as an offense? Answer is no. See, there is a difference between you committing a mistake and you committing a crime. When you commit a crime, that is what is offense, that is what is forbidden by law. And then whatever penalties are later on imposed on you for doing that crime is what is disallowed. But if you do a mistake because of some wrong understanding, you do something, but that is not treated by any law as an offense, like parking on wrong side, getting late and paying some penalty. These will be allowed because they are not getting hit by this condition. So penalties paid in the normal course of business. What type? Breach of contract, non-fulfillment of some conditions imposed by government. Why? Because the government gave you some subsidy. Non-fulfillment of some export performance condition. These are breaches which happen when you are doing business. But here they are not in the nature of any type of offense. It is not a crime to do any of these things. Hence, the penalties paid in these cases are allowed. So students, these are those 4 golden rules, the conditions and the cases where these are not allowed. Right, students? I hope you understood these conditions. When you read section 30 to 37, you find for different expenses, these conditions being given. In few expenses, the names of which I have given, one of those conditions is not given. Why? Because it is the exception. Right, students? So with this, we have completed a major part in our PGBP. Now in the next class, which will be the most technical part of PGBP, is the part B of your debit side. So we were doing part A of your debit side. So part A was what? Part A was golden rules and the exceptions. Now we will be doing part B, that is restrictions and disallowances. Okay? So I hope everything what we discussed today is fine. Okay, Sushmita, I'll upload the file. Fine, students. So thank you. Thank you very much. We connect again in the next class for understanding these technical pointers. In the meantime, you can start studying these provisions, whatever we did in the class at home through your modules, so that we even discuss your doubts from the module. Sridhar, yes, beta, whenever in exams you are doing or solving any answer, working modes are compulsory. In fact, they are allotted specific marks. If you write the answer which is correct, but you have not given the working note, you will not get full marks. Okay? Thank you, students. Thank you. Thank you very much. We again connect with more provisions of this topic. Good day. Keep studying. Be in touch with the subject so that this becomes one of your most strength subjects of your profession and career. Thank you. Good day. Yes, Ashok ji, session over. Thank you to you, sir. Good day.